Have you ever wondered why China's forex reserve levels are continuously declining and why it should concern us all? China's foreign exchange reserves stood at $3.1012 trillion at the end of October, down $13.8 billion from the end of September. The State Administration of Foreign Exchange, SAFE, said on Tuesday. It marked the third consecutive month that the reading has recorded a decline, but the extent of the decline has narrowed from that of September. Before we dive in details, please subscribe to the channel and stay always one step ahead to know all global important events happening around you. Give a thumbs up and share the video with your family and friends. Let's move on with the video. The decrease was mainly a result of a stronger US dollar, which has resulted in global asset price depreciation. Analysts and officials pointed out that China's economic recovery has gained momentum. Also, the fundamentals of the Chinese economy have not changed, which is conducive to maintaining the stability of foreign exchange reserves. Due to monetary policy expectations for major economies, their macroeconomic data as well as geopolitical factors, the US dollar index rose, which resulted in a price slump of global financial assets. So the forex decrease was the combined effect of currency translation and asset price changes, SAFE said. In October, the US dollar index gained 0.49%, and the dollar's exchange rate against the yuan rose 0.64%. News website Gemian.com reported on Tuesday. Analysts added that the depreciation of US Treasury bonds, as a result of a global stock market decline that pushed up bond yields, has exerted pressure on the value of global financial assets. Despite that, China's foreign exchange reserves have still maintained overall stability and have stayed above the level of $3.1 trillion, which provides a foundation for the stability of the yuan, they noted. As of the end of October, China had gold reserves of 71.20 million ounces, increasing for the 12th straight month, data from SAFE showed on Tuesday. The primary purpose of these reserves is to provide a cushion against potential economic shocks. They help to maintain a country's economic stability by providing a source of liquidity in foreign currencies. For example, if a country is hit with a sudden economic downturn, it can use its forex reserves to stabilize its currency, pay for imports or service its external debt. Forex reserves also play a crucial role in managing a country's exchange rate. A country can buy or sell its own currency against foreign currencies to influence its value. For example, if a country's currency is appreciating too rapidly, which could hurt its export sector, the central bank could sell its own currency and buy foreign currencies to stem the rise. Furthermore, an abundant forex reserve can signal to international investors that a country is financially stable, which can attract foreign investments. However, it's important to note that while having substantial forex reserves can be beneficial, holding excessive reserves can also be costly. The management of these reserves involves storage costs, potential losses due to exchange rate movements, and the opportunity cost of the funds tied up in the reserves. Therefore, striking a balance is key. A country needs enough forex reserves to weather economic storms and maintain investor confidence, but not so much that it incurs unnecessary costs or risks, distorting its economy. Now that we have a solid understanding of forex reserves, we can explore why China's forex reserve levels are falling. China, the world's second largest economy, has seen a continuous decline in its forex reserve levels. This is a trend that has been in motion for a while now, and it's one that's causing quite a bit of concern. Let's dive into the specifics. China's forex reserves have been experiencing a downward trend, with significant dips in recent years. Now, this situation is not as straightforward as it seems. It's not just about the numbers, but it's also about what's causing this downward spiral. There are a couple of factors at play here. First, China has been using its forex reserves to support its currency, the yuan. By selling off its reserves, China can keep the yuan from depreciating too rapidly. This is a tactic often employed by countries to stabilize their currency, and it's a double-edged sword. While it can provide short-term relief, it also depletes the forex reserves. Secondly, China's economic slowdown has also played a part in the decline of its forex reserves. With slower growth, there's less foreign capital flowing into the country. This reduces the accumulation of foreign currency reserves. But the most significant factor is perhaps the rising debt levels. China has been borrowing heavily in recent years, and this debt needs to be serviced. This means that China has to use its forex reserves to pay off these debts, leading to a further decline in reserves. This declining trend is worrisome because forex reserves are a crucial buffer for economies. They provide a safety net against economic shocks and are essential for maintaining investor confidence. As the reserves shrink, it becomes increasingly difficult for China to defend its currency and manage its debt. The falling forex reserves present a significant challenge for China's economy and government. It's a delicate balancing act, and how well they navigate this will play a significant role in the country's economic future. It's a situation that deserves our attention, as it has implications not just for China, but for the global economy as well. So, what does this mean for China and the rest of the world? When we talk about the decline in China's forex reserves, we're not merely discussing figures on a balance sheet. Instead, we're delving into a complex economic issue that could potentially affect China's economic stability, its ability to manage its currency and trade, as well as its influence in the global economy. A decrease in forex reserves could lead to a weakening of China's economic stability. Forex reserves act as a buffer, a sort of safety net that a country can rely on during economic downturns. When these reserves dwindle, it reduces the capacity of the government to intervene and stabilize the economy during times of crisis. Furthermore, the decline in forex reserves could impact China's ability to manage its currency. China has traditionally used its massive forex reserves to maintain a desired exchange rate for the yuan. With declining reserves, it might become increasingly challenging for the government to maintain this rate, leading to potential fluctuations and instabilities in the value of the yuan. This could, in turn, affect China's trade scenario. A volatile yuan might make its exports more expensive, potentially impacting its trade balance. Given that China is a major global exporter, this could have ripple effects on global trade dynamics. Lastly, China's influence in the global economy could be affected. Forex reserves are a sign of economic strength. They add credibility to a nation on the global stage. A significant decrease in these reserves could possibly weaken China's standing in the global economy, altering power dynamics and economic relationships. It's like a game of dominoes. Once one piece falls, it can set off a chain reaction. In this case, the falling piece is China's declining forex reserves, and the subsequent pieces represent different aspects of not only China's, but also the global economy. As we can see, the falling forex reserves in China have far-reaching implications. What can China do to address this issue? One potential strategy lies in diversifying its forex reserves. Instead of heavily relying on US dollar assets, China could consider spreading its reserves across a wider range of currencies. This could reduce the risk of any single currency's decline drastically impacting China's forex reserves. However, such a move would require careful planning and execution. It could also cause significant shifts in global currency markets, as the world's second-largest economy adjusts its forex holdings. Another potential course of action would be for China to invest a portion of its reserves into physical assets, such as gold or real estate. While these assets can be volatile, they also offer potential long-term stability and growth. Yet, this strategy could lead to a surge in demand for these assets, potentially driving up global prices. China could also consider developing its domestic financial markets further. By making its markets more attractive to foreign investors, it could draw in more foreign capital, thereby boosting its forex reserves. This strategy, though, could lead to increased volatility in domestic markets and might require significant regulatory reforms. Lastly, China could work towards making the yuan a more internationally accepted currency. This would reduce the need for large forex reserves as a buffer against currency fluctuations. However, this path would require substantial reforms and a willingness to accept the potential risks of a freely floating currency. In implementing these strategies, China will need to balance its domestic economic needs with the potential impacts on the global economy. After all, as one of the world's largest economies, changes in China's forex strategy could send ripples across global financial markets. While the path ahead is challenging, smart strategies and prudent economic management can help China navigate these turbulent waters. Let's quickly recap what we've learned today. We began by exploring forex reserves, their importance as a nation's financial buffer. Then, we dove into China's forex reserves, revealing a continuous decline that has sparked concern. We discussed the potential implications of this trend, including economic instability and government challenges. Finally, we outlined some strategies that could potentially turn the tide. Understanding these economic phenomena helps us make sense of the world around us. Thank you for joining us on this journey into the intricacies of China's economy.